So let's start. So if the contract currency is denominated in a currency that is not a functional or company currency, the initial recognition of both ROU asset and the lease liability, it will be done by taking the spot rate in effect on that day. And for subsequent measurement, the depreciation will be translated using the historical rate unless there have been a remeasurement previously. So if there was an event, then the weighted average rate will be used. For accrual and payment posting, it will take the spot rate. And in case of modification or reassessment, if there is an increase in scope, then we use the spot rate as at the effective date of modification. If there is a decrease in scope, then and if there were no events previously, then we use the historical rate. And if there have been any events, then we use the weighted average rate. And weighted average is calculated by using this formula. So we take the NBV before the remeasurement multiplied by the FX rate at commencement plus the GBV addition multiplied by the FX rate at the date of reassessment divided by the NBV of ROU asset plus ROU asset addition. Do you have any question until here?
Yes, this is Rogelio. What do you mean exactly by historical rate? That means the system is going back to when the lease agreement was for the first time, going back to the initial date.
Yes, so the historical rate over here is the rate we used for inception for the recognition of asset and liability.
Spot rate in effect. I mean, it's the spot rate at the moment when we did the inception.
Yeah, exactly.
Okay. I do have one quick question regarding the exchange rate, because in my company we did a process. We migrated from ECC Nakisa to Nakisa S4HANA, and we decided to do the casualize all the contracts and then recreate it again in when the connection was created to S4HANA, and we have a lot of exchange rate differences because the system in some instances is using the spot rate, and when we do I believe the casualty, but then for the other component of the casualty, the system is using the average spot rate. So my question is this business principle and accounting that we have to do that way? I mean, using in some cases the weighted average rate instead of the spot rate, or using always the spot rate. Is this how should be working according to the business and accounting?
I want to jump in and say that we recently did a similar migration from Nakisa ECC to S4HANA on the GL version, and we saw the same issue. We had a lot of FX movements because of the difference between historic rates on the asset retirements and the new rates that were used.
Okay. But I guess my question is this how the Nakisa, because I have to explain to the business, and we come to the conclusion that the system was, at the beginning, we said, okay, let us check. And then we dig into this and we realize that for the, when we do the casualty, one of the postings in the casualty, I don't remember exactly which one, it was posted with the spot rate, but the others, the other portion was done with the weighted average. And then when we did the inception was posted with the spot rate. So if we compare apples with apples, at the moment, the in and out, where the business was expecting to casualize 100 and then posted 100 in local currency, but that's not the same case when we posted in group currency. So the group currency values, we do have actually a conversation with the business on how we want to remove the variances from the group currency values, because this way that Nakisa is posting the transactions, inception slash casualty, with spot rate versus weighted average. So my question is, so is Nakisa working like that because of a accounting business practice, or?
Mm, just a second, I'll just look into it.
Yeah, we had the same issue here, that exact same issue. We ended up posting manual adjustments for some of the more material movements.
I think yes, we usually do a manual adjustment, but I will get back to you on this one.
Okay, thanks.
Yep. Do anyone have any other question? Okay. So here we have a scenario. We have an active contract from 1st January 2022 to December 2025, and the activation date is on 1st January 2022. The event 1 will be a supplement for USD $2,000 from January 2023 to December 2023. Effective date is 1st January 2023. And then we are doing a reduction for USD 500 from January 2024 to December 2024. And effective date is 1st January 2024. And the exchange rate from USD, our company currency is Canadian dollar. And the exchange rate from USD to Canadian dollars from 1st January 2022, it's 1.262. And in 1st January 2023, it is 1.342. And 1st January 2024, it's 2. So for the inception, we use the to translate the inception entries, we use 1.2616, which was available at 1st January 2022 for both asset as well as liability. And then for the event 1, which was the addition, it is recognized at the rate that is available at 1st January 2023, which is 1.3422. And the event 2, which is a reduction, it will consider the weighted average rate because there have already been a remeasurement. So we calculate this one. We take the NBV of the ROU asset multiplied by the inception rate plus the addition multiplied by the rate that is available at the date of remeasurement divided by the total GBV. Sorry, the NBV plus the addition. So the weighted average rate is 1.2942, and we use that for the reduction event. And we have another scenario where we have a reduction event without any other prior events. So again, the initial recognition will be the rate used at the initial recognition will be the rate available at 1st January 2022. And the next event, which is a reduction, it will take the historical rate since there have been no other event. Do you have any question regarding this?
Pratibha, I have one question, Manip here. Regarding what about if we have two reductions in this scenario? So it's going to use the spot rate at the commencement date?
It will use the, exactly, historical rate because
Okay.
there was no other event, no other increase in scope. So
Okay.
it will take the historical rate.
Okay.
Any other question?
Just to clarify, so in this, because we went through the screenshots, but essentially,
Mm-hmm.
how do we know that the system is going to use the average weighted average rate if we have previously another increase or decrease, or just in which scenario?
Increase in scope. So we will see this in the system right now, and I think that will be better. So here we have a contract, and I have kept the contract rate as 0. It's 360 convention, and for in lease component we have the terms and condition. I have a base rent and supplement and reduction. So for initially, I'm going to exercise only the base rent, and then we'll do a event for supplement and another event for reduction. So I'm going to activate this contract, approve. I'm going to the activation group. I'm going to send it to assessment, approve them. And activate them. So my activation date is 1st January 2022, and my posting date is 1st January 2022. So the system will take the rate that is available as at 1st January 2022 and submitting it. So here we can go to the unit list, and I can see this document. Here for asset capitalization, I have 1.2616, which is the rate that is available at 1st January 2022. So yes, so the initial recognition, it will be at the rate, at the date of 1st January 2022, and the rate is 1.2616. And same for the liability. Now I'm doing another remeasurement. I'm going to situation group level, reassessment. Now a draft will be created. And now I'm going to exercise the supplemental term. Sending to assessment. And over here, my effective date for this particular term is 1st January 2023. And the posting date is 1st January 2023. So the system will consider the rate that is available at 1st January 2023, and I'm submitting it. Now I can merge this draft and I can complete the remeasurement. So for 1st January 2023, the rate is 1.342. Since we are doing a increase in scope, it will take the same rate. So we go to the document, and we can go to the reassessment. For the asset, the system has used 1.3422. And for the liability, again, we have used 1.3422. Now, let's do the reduction event. So again, I'm going to do a reassessment. And I'm exercising the reduction term. Terms and condition. And I'm exercising the send it to assessment. And the effective date for this particular term is 1st January 2024. And I'm using the same posting date. So since there have already been an event, it will consider the weighted average rate. So let's approve this draft, complete the remeasurement, and merge it. Now let's see the document, and we go to the second event. And here we can see the rate used is 1.2942, which is what we have calculated here as the weighted average rate. Does that help?
Pratibha, I have one
Yeah.
question here.
Yeah.
I'm just trying to, while you were explaining this one, I was trying to look into accounting standard. Is there any specific guidance on that, like when it should be decrease in right of use of asset, we should use a weighted average rate instead of spot rate? Or it's
Yes.
just a simplification of the processes?
The system actually comply with the standard, so
Mm-hmm.
it will be in the accounting standard, as per the accounting standard.
Okay.
Yeah.
But it's not directly related to ASC 42 and IFRS 16. I mean, the rules for FX are in other standards.
Mm-hmm.
And so it's the same if you're talking about purchased assets or leased assets. And I don't know if people are reading the chat that I responded to the earlier question. And we're having a little bit of a chat going on the side here. But
Yeah.
essentially, the net book value at all times in functional and reporting currency or company and group currency and SAP terms always needs to end up at zero net book value when you've terminated the lease, whether it's a return, a buyout, a casualty, whatever the case may be. And that applies across all accounting standards.
Mm-hmm.
So that's kind of the ultimate test is, are we winding down to zero or do we have hanging balances in those functional reporting currencies. But yeah, the standards really have not changed as a result, going from 840 to 842 or IAS 17 to IFRS 16. It's the same concepts from an FX perspective.
Okay. Thanks.
Yep.
Okay, now we'll move on to the next scenario, that is having a reduction right after the inception. So I'm just copying this contract. And I'm deleting the supplement event. So I have a base rent, and then I'm going to reassess and do a reduction. So I'm going to send it to approval. I'm going to approve this. And over here, the activation date is 1st January 2022. And the posting date is 1st January 2022. And the rate for inception will be based on the posting date. So 1st January 2022. I'm submitting it. So going back to the unit list, asset, we see, excuse me. This is the asset capitalization, and we are using 1.2616. That is the rate that is available on 1st January 2022. And now let's do a reduction. So I am with collecting reassessment. And I'm going to the terms and condition, and I am exercising the reduction term. And I'm using 1st January 2024 as the effective date. And the posting date is 1st January 2024 too. But since it's a reduction, the system will consider the historical rate to recognize it. I'm going to complete remeasurement and confirm it. And let's go to the unit list and the document and select reassessment. And here we can see the reduction is done, is translated in at 1.2616, which was the rate that is available as at 1st January 2022.